What if I told you that the world's biggest gold vaults are quietly tightening, while demand for physical gold keeps rising? And most retail investors have no idea what's happening behind the scenes. Welcome back to ACapitalTrades. I'm Gift. And today we're breaking down why gold and silver demand is surging during global conflict, why vault supplies are tightening, and more importantly, the hidden signals smart money watches before the next massive move in precious metals. Let's get into it. Part 1. The quiet tightening of gold vaults. Recently, there's been growing discussion about tight supply inside major gold vault systems. Two of the most important institutions in the global gold market are COMEX and the London Bullion Market Association. These institutions are essentially the backbone of the global gold trading system. But here's what many people don't understand. Most gold trading today is paper gold, meaning contracts that represent gold, but not necessarily physical bars being moved. However, something interesting is happening. More investors are starting to demand physical delivery instead of paper exposure, and that shift changes everything. Part 2. Why physical demand is increasing. There are three major forces behind this shift. First, central banks are accumulating gold. Countries like China, Russia, India, and Turkey have been aggressively increasing reserves because gold is a neutral asset outside the global financial system. Second, investors are converting paper gold into physical metal. After years of financial instability and massive money printing, some large investors simply don't trust synthetic exposure anymore. And third, geopolitical uncertainty. When global tensions rise, institutions prefer assets without counterparty risk. Gold fits that description perfectly. Part 3. The mining supply problem. Now here's something extremely important most people overlook. Even if demand explodes tomorrow, mining supply cannot increase quickly. Large mining companies like Newmont Corporation, Barrick Gold, and First Majestic Silver cannot suddenly double production. Developing a new mine often takes 10 to 15 years. There are environmental approvals, exploration phases, infrastructure development, and billions in capital investment. So when demand rises quickly, supply simply cannot keep up. And that imbalance historically creates powerful price movements. Part 4. Why silver might be the real story. Now let's talk about something even more interesting. Silver. Unlike gold, silver is not only a monetary metal, it's also a critical industrial material. Silver is essential for solar panels, electronics, military technology, and electric vehicles. But here's the key difference between gold and silver. Most gold ever mined still exists today. Silver, on the other hand, is consumed in industrial processes, meaning once it's used, a large portion of it is never recovered. That's why some analysts believe silver could eventually face a tighter supply situation than gold. Part 5. Sanctions and the shift away from the dollar. Another factor changing the gold market is global trade fragmentation. Sanctions placed on Russia have forced several countries to rethink how they settle international trade. Instead of relying solely on the US dollar system, some countries are exploring settlements using local currencies and gold. When global trade begins shifting toward commodity-backed settlement systems, gold naturally becomes more important. Part 6. Institutional money is also flowing in. Retail investors are not the only ones watching precious metals. Large institutions gain exposure through ETFs such as SPDR Gold Shares and iShares Silver Trust. When billions flow into these ETFs, the funds must often increase physical metal holdings to support the inflows. Part 7. The oil connection most investors miss. There's also an important macro relationship many traders overlook. Gold and oil are closely linked. When oil benchmarks like Brent Crude and WTI rise sharply, they often push inflation higher. And historically, rising inflation tends to drive capital into gold as a store of value. Part 8. The trust problem in the financial system. Since the 2008 global financial crisis, a growing number of investors have become skeptical of traditional financial systems. Massive monetary stimulus, debt expansion, and financial engineering have led many institutions to question long-term currency stability. And when trust declines, capital flows into hard assets. Part 9. Rare signals, smart money watches. Serious investors don't just watch price charts, they monitor hidden indicators that reveal institutional activity. Here are a few advanced signals. First, COMEX registered versus eligible gold inventory trends. Second, central bank gold purchases, signaling long-term strategic positioning. Third, the gold to silver ratio. When this ratio begins compressing rapidly, it historically signals silver outperformance cycles. Fourth, futures backwardation. And fifth, mining stock divergence. Sometimes mining stocks begin rising before gold itself moves, signaling institutional accumulation. Part 10. How traders and investors can prepare. For traders and investors watching this space, preparation is key. Professionals look for consolidation periods, rising institutional inflows, declining vault inventories, and strengthening mining stocks. When these signals align, they precede powerful upward cycles. The precious metals market is one of the most misunderstood areas in global finance, but when you start connecting macro events, the bigger picture becomes much clearer. Some of the most important movements in gold and silver happen long before the headlines appear. If you want to stay ahead of these moves, make sure you're paying attention to the fundamentals. If you found value in this breakdown, make sure to like the video, subscribe to ACapitalTrades, and turn on notifications. I'm Gift, and I'll see you in the next one.